Hey everybody, hope you're doing good. I wanted to go over some short-term rental financing details, some key points. Airbnb, vacation rental by owner, for property investors looking to get into short-term rental properties. These are some key points in short-term rental financing that you need to be aware of. So hopefully this will be helpful for you Texas real estate investors. Yep. So, what loan do you use for a finance a short-term rental? What kind of loans? And you can use conventional financing, but the biggest tool that investors are using today is DSCR loans, or debt service coverage ratio loans, is the primary financing tool most investors use today. Qualifies on the property's rental income, not your W-2s, pay stubs, tax returns, that sort of thing. As far as why DSCR works for short-term rental debt service coverage ratio loans. You can use AirDNA and RABU for property projections. No limited amount of properties. You can own more than 10. Conventional financings, you're capped at 10 properties. With these DSCR loans, short-term rental loans, debt service coverage ratio loans, you can have many properties, unlimited properties. And plus you can close in an LLC, which is very nice too. So how do lenders calculate short-term rental income? They'll use an AirDNA report or a RABU report for these are accepted for new purchases with no rental history. Otherwise, if there's rental history, an appraiser will do an appraisal on the property and fill out a Form 1007, which is a documented and projected rental income report on that particular property. They'll use a 12 or 24 month platform. That way, they take a smooth 12-month transaction. There'll be some lulls in activity certain months where rental property won't be rented as often as say the peak travel season or vacation season for that particular property, especially if you have property like a South Padre, Port Aransas, that sort of thing. Lenders also apply a 20 or 24 month, a 20 or 25% percentage reduction in the actual income itself. They take in consideration, property management fees, cleaning fees, that sort of thing. So they'll never take the full 100% of the projected income. They always do like a quote unquote haircut rule. Well, they'll do a discount of 20 or 25% off that. So you got to be aware of that also. Yeah, as I stated before, why don't lenders use your full short-term rental income? Lenders don't use 100% of the income. They'll do a 20 or 25% reduction is applied, or it's kind of a quote-unquote haircut rule, or they'll use a multiplier of 75 or 80% of the projected income. And this takes in consideration, once again, a maintenance, cleaning fees, management fees, property management fees, all of that. So you got to be aware of that also. If something like that, where they reduce us and we run into DSCR ratio problems, which, you need to have 1.0 or better, you can always do an interest only or a longer term to make those ratios work for you. So how much money do you need to put down generally on a short-term rental, down payment wise? On a short-term rental using a DSCR loan or debt service coverage ratio loan, the maximum loan to value is 80%, and you generally need right around a 720 or higher credit score. If you're under 720, say 700, you're at 75% loan to value on a purchase or 25% down. And if you don't have a short-term rental history of owning other short-term rentals, this is your first one, so to speak. More often than not, they'll reduce the loan to value by another 5%, so it'd be 70% loan to value. Refinances, you can do a rate and term refinance on these short-term rentals. The maximum loan to value is 75%. If you do cash out, if you want to cash out to say buy another property, that loan to value drops to 70%. And once again, you need to have that 720 score to get the best rates and terms. Yep. So what debt service coverage ratio do I need for a short-term rental? 1.0 is where the actual rental income on a monthly basis covers your monthly mortgage payment. That's principal, interest, taxes, and insurance, and HOA. Ideally, 1.25 for the best rate and terms, so there's some cushion in there. Interest-only options are available, 40-year terms. If that debt service coverage ratio gets tight, that's certainly an option too. Or obviously, which goes without saying, a larger down payment if that's what you got to do to make the deal work, if that's possible or feasible. So to recap, what credit score and how much experience, in terms of qualifying for the mortgage, do you need to purchase a short-term rental? Once again, you need a 700 score minimum generally, to get the higher loan to value of at least 75%. If you can get yourself over 720 credit score, then we can get closer to 80% or 80% loan to value for that matter. Minimum trade lines, you need 3 trade lines. Any other mortgage history clean, obviously, to get, it's irrelevant because, you're gonna have to have perfect credit anyway to get to 720. So experience, you need to have some kind of experience owning investment properties in the past, whether that's a regular non-owner occupied investment property or short-term rental property. Um, at least 1 year in the last 3 years. So if you sold a property 2 years ago, that would still work, being that you had at least 1 year experience. Um, these short-term rental programs are for experienced investors only, and new property investors, it gets pretty hard getting that past underwriting, and only one borrower, for that matter, needs to meet. So if you're married and you and your wife need to be on the mortgage, as long as one of you has that rental experience, that works too. Going back, can you refinance or pull cash out on a short-term rental? Absolutely. 70% loan to value on a cash out. Say you want to pull cash out to buy another property, for that matter. Actually, 75% loan to value on a rate and term. I know the screen says 70%. That's not right. It's actually 75% rate and term, 70% cash out. And once again, that credit score, you need to be somewhere in that 700 to 720 range. When they calculate their income, you're using that form 1007, which is an appraisal form. Um, Properties must be owned within, they need to be owned for at least 6 months straight from the seasoning standpoint to get a new appraisal value. And you cannot do a cash out refinance again within 6 months. Keep that in mind. Can you close your short term rental in an LLC? Absolutely. That's the preferred way. Provides asset protection, separates your personal assets from your investment property, keeps your portfolio organized. You need to have a business purpose certification required at close, LLC operating agreement, and certificate of good standing required at closing, Texas Secretary of State validation. It must be certified within the last 30 days before close, and the borrowers also sign a personal guarantee. So it's not a non-recourse loan; it's a fully recourse loan. But at the same time, you can close it at an LLC. So yeah, so these loans, they come with a prepayment penalty. That's something to keep in mind. Why do they exist? DSCR loans are non-qualified mortgage loans. They're not an FHA or a VA or a conventional loan, for that matter. They're non-qualified. So you can do a prepayment penalty. These are more of a business purpose loans. They come in a 1, 2, 3, 4, 5 year prepayment penalty, 2 to 3 to 4 to 5% a penalty on the loan amount, the balance, if you either refinance or sell. So they are quote unquote hard prepayment penalties. Why? There's specific yield over a specific time period. These are considered. They sell these in mortgage-backed securities. So when investors buy these particular debt instruments, they're guaranteed a certain yield. So this is more of it prevents or it deters people from trying to refinance to get a lower rate, that sort of thing, and recoups costs in case the bond yields and the bond prices change over time. So that's something that it kind of keeps things intact, so to speak. So like I said, it's 1, 2, 3, 4, 5 year options. I mean, you can buy out the prepayment penalty. What I mean by that is, you're paying it through the rate. So if you do, like, say, 6.125 and a 30-year fix on a 3 year or 4 year prepayment penalty, you could do a no prepayment penalty at, say, 6.5 or 6.75%. So these are all options, especially if you don't think you're going to keep the property for any length of time, meaning within that prepayment penalty period, whether that's 2, 3, 4, or 5 years. So keep that in mind also. What can or usually kills your short-term rental deal before it closes? Lender requires proof from the local municipality, i.e., your city, that that they do it. In fact, let you have short-term rentals. For example, Austin, you know, or any of these other cities, if they require, if they actually allow short-term rentals, that's the first and foremost things. Then you're going to need permits and licenses rather, and these are all things that you need to have before close. If the city or the county prohibits short-term rentals, i.e., meaning less than 30 days, then you're kind of out of luck. So you got to keep that in mind and do your research. But some of these Texas cities have short-term rental ordinances. You just got to look at these, look into the city and do your homework and make sure that everything's on the up and up on that end. And also keep in mind HOA. You want to get your HOA documents. Not all HOAs accept short-term rentals, so you got to get your documents, do your research on that to make sure that the short-term rentals are going to be okay in that particular HOA community. So once again, the city and the HOA, you got to do your homework on, do your research, make sure that you're A-okay on both those ends, because those are two things right then and there that can really trip up or for sure kill a deal. Because if either one of those doesn't accept short-term rentals, then you're out of luck. So keep that in mind. Yeah, so I hope this information was helpful for you. Whether you're an experienced property investor or you're looking to buy your first short-term rental property, there's some tidbits in here that I hope would be helpful for you. These short-term rental properties are a little different in terms of financing a regular non-owner occupied property. There's things you got to be aware of, obviously, just to keep in mind and to reiterate. The DSCR, the debt service coverage ratio loans, are the kind of the primary mortgage tool or the mortgage instrument that's being used today in this arena of the short-term rental property investment property. So once again, the property itself qualifies, the actual deal, the actual mortgage, as long as the monthly income covers the mortgage, the principal interest, the taxes, the insurance, the HOA, at least at a 1.0 or higher, hopefully at 1.25. That gets you the best rate, the best terms. You need a minimum. Generally, you want to stay. If you have to have good credit. You have to have 700 credit score, hopefully 720 or above to get to that 80% or 20% down range. Prepayment penalties, be aware of them. If you don't plan on keeping the property for any length of time or you're not sure, maybe you want to consider buying that prepayment penalty out. These are all terms. These are all they'll all be presented to you at the front, so you can make your own informed decision as far as what you want to do with that. Keep in mind that the local HOAs, your city ordinances, municipalities, obviously, whether they take short-term rentals, you need to have your permits in place, licenses, that whole thing before close. So these are all things, as a recap to be aware of. So once again, I'm Jim Kennedy with Kennedy Mortgage. I'm out of Austin, 512-553-2111. Reach out, give me a call, leave a comment. I'd be more than happy to help if you have questions. Thank you very much.